Welcome to the deep dive. Today, we're really getting into the essential first steps, the absolute must-knows for anyone looking at the financial markets,
Yeah, whether it's stocks, forex, maybe commodities.
or even those trickier derivatives. The goal here is to cut through the noise.
Exactly. We want to pull out the really critical advice.
Stuff from seasoned traders, from solid trading principles, so you, the listener, don't feel totally overwhelmed starting out.
Right. Give you some clarity, some actionable things to focus on.
Okay, let's dive in.
It's interesting because the markets themselves are so varied, but the core lessons for newcomers, they're pretty consistent across the board.
It always comes back to certain fundamentals, doesn't it?
It really does. Building a solid approach, something sustainable, not just, chasing quick money. It starts with really understanding the landscape and having discipline.
Absolutely. So first base then. Someone's brand new. Where do they even start?
Okay, first, you just need to get your head around the basics. How prices get set, buyers, sellers, that whole interaction, and what the different instruments like stocks or bonds actually are.
Right, the mechanics.
But honestly, before even thinking about making a trade, you need to think about protecting yourself financially.
Risk management.
Yes, risk management.
It comes up constantly. It doesn't sound maybe as exciting as finding a winner, but everyone stresses it. Why is it so foundational right from day one?
Well, think of it like this. You wouldn't get in a car without knowing where the brakes are.
Right. Okay. Good analogy.
Risk management is basically your financial brakes. And a huge part of that, maybe the cornerstone, is the 1-2% rule.
Explain that one.
It just means you shouldn't put more than, say, 1 or 2% of your total trading money into a single trade.
That sounds quite small.
It does. But so many beginners trip up here. They get excited, maybe a bit greedy, risk way too much on one idea.
And one bad trade can wipe out a big chunk of their capital.
Exactly. Applying this rule consistently, even when you feel super confident about a trade, is just vital for staying in the game long enough to learn. It keeps your capital safe for the next opportunity.
Makes sense. Protect the war chest.
And just as important are stop-loss orders.
Right, the automatic exit strategy.
Precisely. You set a price level beforehand. If the trade goes against you and hits that price,
Poof, it closes automatically.
yep, it closes the trade, cuts your losses. Like an emergency brake, it stops things from getting worse.
Okay, so managing risk on each trade is key. But what about the bigger picture? Having an overall strategy. That's the trading plan, right?
Yes, exactly. Your trading plan is like your personal rule book, your roadmap.
So what goes in it?
Well, it needs to clearly state your goals. Are you aiming for quick slips or longer-term growth? What's your tolerance for risk? How much volatility can you actually stomach?
Emotionally and financially.
Right. And then critically, your specific rules for getting into a trade and getting out.
Entry and exit criteria.
Under what exact conditions will you buy? When will you sell? Having this written down beforehand, it helps you act rationally.
Instead of just reacting emotionally when the market's going wild.
That's the idea. It keeps you grounded.
Incredibly useful. I can see that. Okay, so you've got your risk managed. You've got a plan. How do you actually find trades? Now we're talking analysis, technical, fundamental.
Spot on. Technical analysis is basically learning to read the charts.
Looking at price action, volume.
Exactly. Studying past market data to try and anticipate future movements. You might learn to spot common chart patterns like a head and shoulders pattern.
Which often signals a trend might be reversing.
Or things like triangles, which usually show the market consolidating before a potential breakout. Candlesticks are useful too.
They show they open, high, low, close for a period.
Yeah, and the body and wicks tell you a story about the buying and selling pressure during that time. A big green candle. Lots of buying.
And trend lines just help you see the overall direction.
Yep, visually connecting the highs or lows to see the prevailing trend.
Okay, so reading the chart's story, what about all those indicators people overlay? The squiggly lines.
Ah, yes, indicators. Things like moving averages, RSI, MACD, Bollinger Bands.
Lots of acronyms.
Yes. They're basically mathematical calculations based on past price or volume. They can help highlight potential turning points or overbought, oversold conditions.
But there's always a but, isn't there?
There is. And it's crucial, especially for new traders. Don't treat indicators like gospel. Don't rely on them alone.
Why not?
Because they're lagging. They tell you what has happened based on past data. A moving average crossover might confirm a trend change happened, but it won't predict it perfectly.
So they're more for confirmation.
Exactly. Use them to support what you're already seeing in the price action or patterns. Look for confluence, multiple signals pointing the same way, but an indicator signal by itself, not usually a strong enough reason to trade.
Got it. Don't follow them blindly. So that's technicals. What about fundamental analysis? That seems more about the why behind the price, especially for stocks.
That's a good way to put it. Fundamental analysis looks at the intrinsic value. For a stock, you dig into the company's health.
Like their earnings reports.
Yep, earnings, PE ratios, the price relative to earnings, revenue growth, debt levels.
The underlying business performance.
And you'd also consider the bigger picture macroeconomic factors, the state of the industry, interest rates, things like that. It's generally more focused on longer-term investing, trying to find undervalued assets.
Okay, so evaluating the actual thing you're trading. Now, I've also heard people stress looking at charts on different time frames. Why bother with, say, a daily chart and an hourly chart?
Multiple time frame analysis. It's about context. Hugely important.
How so?
Well, imagine you see what looks like a great buy signal on a 15-minute chart.
Okay.
But then you zoom out to the daily chart and you see the price is actually in a strong downtrend and just hitting a major resistance level.
So the short-term signal might be a trap within a bigger downward move.
Precisely. Looking at the longer time frame gives you the bigger picture, the dominant trend. Then you can use shorter time frames to fine-tune your entry or exit within that larger context. It's like having both a satellite view and a street map. You need both to navigate effectively.
Great analogy. Okay, so analysis is key, but trading isn't just charts and numbers, is it? There's the whole mental game.
Oh, absolutely. The psychology aspect is massive. Market psychology, the collective emotions of all traders is a huge driver of price.
Fear and greed, right, the classics.
They're the big ones. Fear can cause panic selling, driving prices down sharply. Greed can fuel bubbles and lead to irrational buying. Understanding that these emotions are always swirling in the market helps you recognize them in yourself, too.
So how does an individual trader manage their own emotions in that environment? It sounds tough.
It is tough. That's where emotional discipline comes in. It's probably one of the hardest parts of trading.
Sticking to the plan even when you feel scared or overly excited.
Exactly that. You have your trading plan, your rules. Discipline means following them, even when your gut is screaming to do something else. Specifically, you have to fight FOMO, the fear of missing out.
Chasing trades because you see something moving fast and you don't want to miss the profit.
Right, which often leads to entering late at a bad price without proper analysis. And the flip side is resisting panic when a trade goes against you slightly, sticking to your stop loss, not just closing out in fear.
And patience must be part of that too.
Huge part. You don't have to be trading all the time. Sometimes the best trade is no trade. You need patience to wait for the high probability setups, the ones that really fit your plan and criteria.
Easier said than done, I imagine. Okay, let's shift gears to practical setup. Someone's convinced they want to start. What are the first logistical steps, like choosing a broker?
Yeah, broker selection is step one for actually placing trades. You want someone reputable.
What makes them reputable?
Look for good regulation. Are they overseen by a major financial authority in your country or region? That offers some protection. They compare fees, commissions, spreads.
The costs of trading.
Right. And check out their trading platform. Is it easy to use? Does it have the charting tools you need? Find one you're comfortable with.
Okay. And what about leverage? Brokers often advertise high leverage.
Leverage. It's a double-edged sword, truly. It lets you control a larger position with a smaller amount of capital.
Magnifying potential profits.
But it magnifies potential losses just as much, if not more. New traders really need to be extremely cautious with leverage. Start with very low leverage, or none at all, until you really understand the risks involved. High leverage can wipe out an account very, very quickly.
Treat it with extreme respect. Got it. What about practicing without risking real money? Is paper trading actually useful?
Immensely useful. Essential, I'd say. Paper trading means using a demo account with virtual money.
So you can place trades in the live market, see how they do, but with no actual cash on the line.
Exactly. It lets you get familiar with the broker's platform, test out your strategies, see how they perform in real market conditions, build confidence, all completely risk-free. It's like a flight simulator for traders.
Okay, definitely sounds worthwhile. What else helps with learning? I hear journaling is important.
Oh, keeping a trading journal is critical for improvement. Seriously, underrated.
What do you track? Just wins and losses?
Much more than that. For every trade, you should record why you took it, what your setup was, your entry price, your stop loss, your target, the exit price, and importantly, how you felt during the trade. And the outcome, of course.
So you can go back and see what worked, what didn't, and why.
Precisely. It creates a feedback loop. You can spot patterns, maybe you consistently make mistakes when you trade certain setups, or maybe you panic, exit winning trades too early. The journal reveals your strengths and weaknesses like nothing else.
Your own personal data analysis tool. Okay, when reviewing that journal, what metrics matter most? Is it just about winning more trades than you lose?
Your win-loss ratio is one piece, sure, but it's not the whole story. What's often more important is your risk-reward ratio.
Meaning how much you stand to win compared to how much you risk on a trade.
Exactly. Think about it. You could win only 40% of your trades, but if your winners are, say, 3 times bigger than your losers on average.
You can still be profitable overall.
Right. Aiming for trades where the potential reward outweighs the potential risk, like a 1.2 or 1.3 ratio, is a cornerstone of many successful strategies.
That makes a lot of sense. You also hear, the trend is your friend. What's the thinking there?
Trend following, the classic approach. The idea is simply to identify the dominant direction the market is moving up, down, or sideways, and trade with that trend, not against it. Fighting a strong trend is usually a losing battle, especially for beginners.
Go with the flow?
Pretty much. And related to that is identifying support and resistance levels.
Price areas where the market seems to pause or reverse?
Yeah. Support is a level where buying pressure tends to overcome selling pressure, stopping a downtrend, at least temporarily. Resistance is the opposite, where selling pressure overcomes buying, halting an uptrend. These levels can be good spots to look for entries or place stop losses.
Okay. And does volume, how much is being traded, tell you anything?
Oh, definitely. Volume analysis can help confirm price movements. For instance, if a price breaks out above a key resistance level on really high volume.
That suggests strong conviction behind the move.
Exactly. It makes the breakout more likely to be genuine. Conversely, a breakout on very low volume might be suspect, more likely to fail. Volume adds another layer of confirmation.
So looking at price, patterns, indicators, volume, multiple time frames, quite a lot to juggle. What about outside influences, like news?
News impact. You absolutely have to be aware of it. Major economic data releases.
Like inflation numbers, unemployment reports.
Central bank interest rate decisions, company earnings announcements if you're trading stocks. These events can cause huge sudden spikes in volatility.
So you need to know when they're coming.
Yes. Use an economic calendar. Know what's scheduled. Some traders avoid trading around major news events altogether because it's unpredictable. Others try to trade the reaction. But you need to be aware and have a plan for it.
Okay. And briefly, there are different styles of trading too, right? Not everyone holds trades for the same duration.
Correct. You've got day traders who are in and out within the same day. Swing traders might hold positions for several days or weeks to catch a larger swing in price.
Then scalpers.
Scalpers aim for tiny profits on lots of trades, often holding for just minutes or even seconds. And then long-term investors might hold for months or years, focusing more on fundamentals.
Finding a style that fits your personality and time availability seems important.
Crucial. And alongside style, understand different order types, beyond just hitting buy or sell at the current market price.
There are limit orders, stop orders.
Yes. A limit order lets you specify the price you want to buy or sell at. A stop order becomes a market order once a certain price is hit, used for stop losses, or sometimes to enter breakouts. Trailing stops are useful too. They lock in profit by moving your stop loss up automatically as the price moves in your favor.
Lots of tools in the toolbox. Okay, thinking about pitfalls now. What are the biggest mistakes new traders make that they really need to avoid?
Number one priority, always, especially at the start, capital preservation. Don't lose your starting money.
Protect your capital above all else.
Absolutely. Which leads to avoiding overtrading, feeling like you have to be in a trade all the time. That usually leads to taking bad trades, low probability setups that don't really fit your plan, and it racks up commission costs.
Be selective.
Be selective, be patient, don't chase every wiggle. Also, think about diversification. Don't put all your eggs in one basket, whether that's one stock, one currency pair, or one sector. Spreading risk helps.
Makes sense. Anything else?
Understand the tax implications in your country. Trading profits are often taxable income. And please, please be wary of scams.
The get-rich-quick schemes.
Yes. Anyone promising guarantee high returns with little risk is almost certainly lying. Stick to regulated brokers and verified information sources. If it sounds too good to be true, it is.
Good warning. What else?
Continuous learning. The markets change. You need to keep studying, keep reading, keep learning new strategies, stay updated, and related to that, adaptability.
Markets aren't always the same.
No way. Sometimes they're trending strongly, sometimes they're choppy and range-bound, sometimes they're highly volatile. A strategy that works well in one condition might fail miserably in another. You need to be able to recognize the current market environment and adapt your approach if necessary.
So it's a constant process of learning and adjusting. Okay, to wrap this all up then, if you could give one core piece of actionable advice to someone starting this journey, what would it be?
Create that trading plan we talked about. That detailed roadmap of your goals, risk tolerance, entry-exit rules, write it down. And then this is the hard part, have the discipline to actually stick to it.
Plan the trade, trade the plan.
That's the mantra. Combine that plan with practice. Use paper trading extensively first. And review everything meticulously with your trading journal. Consistency doesn't happen overnight. It's built through disciplined application of sound principles, learning from mistakes over time.
Fantastic summary. Okay, so for you, the listener, embarking on this path, here's something to think about. Of all these foundational ideas we've discussed, risk management, the trading plan, analysis, psychology, which one feels most crucial for you to nail down right now? Which principle resonates the most? And how could really focusing on mastering just that one thing significantly change how you approach learning about and navigating these markets from the get-go? It's definitely an exciting journey. Keep exploring, keep that curiosity alive, and keep learning. Thanks for diving deep with us today.